All right, good morning, everybody. Green on the screen a bit. The move that started after the open yesterday kind of stalled out a little bit. Although we're still holding what we took. It's a good start. Job week continues. We will continue to get jobs data every day this week, and its importance will rise as we get higher into the end of the week, because that's just how it goes. We have some Fed speakers this afternoon, but really they're just saying the same thing at this point. We're not getting anything new out of them, not getting any insight on the bill. There's no issue of clarity that they're trying to iron out. Really not expecting much. In the overnight tonight, we are going to get more data out of Japan. So we want to be thinking about tomorrow's data and what tomorrow's charts are going to look like when we come in. As you can see, we've got a lot of potential economic events through the morning that are in red. But once we get into the afternoon, things quiet down quite a bit. The beige book, I would never say that any of our economic events are something that we can ignore, but I don't have a lot of expectation when it comes to the beige book. So we'll get it. We'll take a look at it. We'll see if the market even cares at this point. But that would be the last thing for the afternoon. So I'd say we're basically done by lunch, and that we can just focus on treasury yields and options at that point. But, keep your ear out. It is Wednesday, so we're going to get crude oil inventories at 10:30. This is a staple. It's a weekly event. A lot of times, crude really doesn't move us around that much, but we've seen some funny business in the crude recently, and with a lot of headlines on war and global events, it's worth keeping your eye on that one. See what kind of impact it brings at 10:30. Overnight volume sitting around 57. So we're still within our normal range. Getting back to a more consistent overnight value is a good thing. At this point, we are focused on this 111 inside day breakout of yesterday. We didn't keep the breakout. We're back inside, but we're holding the line. And if we measure all of yesterday, then we haven't even made it up to the 111 yet. The 1, 2, 3, 6 of yesterday lines up on the call wall, which for the 1, 2, 3, 6, that would be as much of the breakout as we would expect if the breakout's going to stall. It gets us up into that 6,000 range, maybe a little bit of an overshoot like we did before we stall and come back down again. 59.92 cog line, and above that 60.20. We haven't managed to even get that high up, so we're right back at previous resistance. Maybe this time we get there. The sell-off from the first time was a lot more violent than the sell-off the second time. If we sell off again, which is always possible, then we are expecting higher lows to continue. When it comes to one of these flat top wedges, though, this area here becomes really important. We're not supposed to take the last 20%. If you've studied any of those wedges or flat top, flat bottom, apex is the last 25%, 20% or so. We shouldn't get into that part of the wedge. So we'll be looking for either a fake breakout fast fail from there, which would be a topside fake breakout before dumping down, or just a real breakout. And we've already got tighter into that wedge than we should have, which tells us that it's likely not going to follow through the way a wedge typically would, right? It's one of the tells that the wedge isn't going to behave as we expect it would, is that if you get too deep into that wedge, right? See if we can. So if that's the wedge, we shouldn't get into that last bit, right? That's 20% or so. If we do, then it tells us that this isn't likely to follow through the way we would expect it to. That's the takeaway. Doesn't mean that it can't, just that it's less likely to do what it's expected to do. Still 59.92 cog line. We're dancing there now and holding above VWAP. So break VWAP and we can challenge all of the Globex that we've got at this point, dealing with our own Globex low. That would line us up with the 786 of yesterday. When we measure all of that, a pullback to 786 is what we'd expect before we continue on. That's just what we do, right? But if we make that sort of move and we pull back to 786 and we're unable to keep it, then we end up going the other way. So it is a resolution one way or the other. If we break VWAP, aim for the 786. If we break that, we go for the half. You get the idea. Level by level, run it on back down. We'll dance it the other direction. 59.65, the 4-period daily moving average. We're above it. We need to keep it. That'll be a nice line in the sand. If we cut the 4, we'll aim for the 10. If we cut the 10, we've got 0 gamma and volatility trigger, which is at yesterday's low and then a little below yesterday's low, with the 3-week moving average underneath that. Under last week's low, or close to it, we've got the 20-period daily moving average, and a long ways off, we've got the 10-week. Today's ADR around 84 points. We're not really close to the upper edge or the lower edge, since we're barely up, not even 0.25% this morning. So no edge towards one side or the other. It is worth noting that if we want to get to the upper edge here, we have to get that inside day breakout. But to get to the lower edge, we don't need any sort of inside day breakout at all. We can just go on down there and hit it. Generically speaking, if you get an inside day breakout, you're supposed to keep it, not supposed to give it back. So the fact that we already did an inside day breakout and we were not able to keep it, it kind of says a lot about what's going on this morning. But we didn't sell off, right? It wasn't like some big sweeping dump after we hit some level and then failed miserably. We poked above the line and now we're just chopping at that cog line. So if we do start to give way, like a boulder rolling down the hill, it may start out really slow, but it'll pick up momentum on the way down. So just kind of keep that in mind. We just haven't started the rollover yet. And it doesn't have to roll over, right? We can check our own Globex low against that 786, and then we can just run right back up and continue the drive to the upside. Today's floor pivot is wide, like yesterday's floor pivot, which implies if we break out that the breakout won't stick. Today's pivot is higher than yesterday's. That's bullish. Price is above today's pivot, and that's also bullish. We've got an MDP this morning. That's a missed daily pivot. Markets generally hit their pivot more often than not. So the base case or the expectation is that we'll come down and we'll hit this because, well, that's generally what we do. When we don't hit it, it counts tomorrow, not today, because we would have to go all day today without hitting it before it is officially an entire day that we didn't hit the pivot. With yesterday's pivot, we made it to R1, and that's where we stalled out. Today, we're not at the R1 yet. 6011 cog line is where the R1 is at, so that's what we would expect, right? 5992 is a cog line, 6011 is a cog line. Get there, see what we're going to do after we do. Otherwise, if we get back inside this channel, we'll expect to get to the floor pivot. If we can undercut that, then we've got 5950, so options level round number. Then 5932 cog line and S1 down here. We are above the weekly floor pivot, 5911 cog line. It's funny how those just keep showing up everywhere. At this point, from that level, we're not overextended, we're not overbought. We haven't traveled too far too fast, and it doesn't owe us any sort of mean reversion, least squared method, dot plot statistics, or any other reason to pull back at this point. We're fine. But it is a narrow channel, and the narrow channel implies that if we do break out on the week, that the breakout sticks and we keep it. So we're talking about a weekly breakout. We don't want to go to a weekly chart and consider the candle that we need to break out of. We've been running this for nearly a month. This is last week's range that we're talking about. That floor pivot on the week suggests that if we break out of last week's range, that we keep the breakout. It would be very much like this breakout we had between these 2 weeks. So this was an inside week. We had a breakout that stuck, and we kept the week. Of course, that put us in the range that we are now, but there you go. This is IX10 on the weekly as well. So, inside a week, 4 weeks. It's not overly impactful because it's a bit wide. But all things considered, for the last 3 weeks, when we've gotten above this level, we haven't been able to keep it. Sell off every single time. So far, we're keeping the breakout, right? So far. But the week isn't done, and this is the critical area. So it's a pivotal moment on the week, on the month, and really for the quarter. What are we going to do with this level? And are we going to be able to keep it or not? We haven't managed to do it for 3 weeks. Maybe fourth time's the charm, right? We brought the point of control for the week up to us yesterday Right now, it's just below us at that 59.80 area. 57,000 today. I mean, it's always possible, right? I wouldn't ever want to say that price can't do something, but that would be wild, wouldn't it? Unlikely, but it's definitely doable. So we brought the point of control up, and really, if you look at that reversal that I pointed out earlier, there's almost no footprint up there, right? So the last time we got up there, there just wasn't any real participation, and we fell back down again. It was real shallow getting up into it, then it just fell apart. It was curious that we were able to even cut through the previous week's point of control when we did that, right? Generally speaking, we shouldn't have been able to run through that zone so easily. It should have been a more restrictive area, and it wasn't. So we cut through it both directions like it wasn't even there. We didn't leave much across the highs before we fell over, and now we're running back up into it again. The difference is that we brought the point of control up with this, whereas last week, right, we didn't when we were topping out up there. Last week we had more of a classic distributive pattern other than that little nodule up there. This week we've got 3 different high volume zones. So, you know, when we zoom out, this whole thing collectively is the topping pattern that we really want to evaluate, which is why we put it on the 10-day, 30-minute, kind of look at all of it together. We've still got the point of control below us. We're not looking to see that change anytime soon. And we're not building out a new level fast enough to make it move before we wipe out the volume that created it, right? So the idea behind that statement is if we had ran up into this previous level and we put in a massive amount of volume up here, which you can see we put in a little, but if we had put in a massive amount, the point of control would move up here, even though the candles that made this point of control haven't been taken off the board yet. It would just be that much. But we don't have that. So what's more likely is for every new candle we get on the right, we're going to lose one on the left. We're eventually going to wipe this volume out. And that point of control by default will move to a new spot because there just isn't any volume there anymore. Well, they're certainly defending that high this morning. So classic shape. Yesterday we ran up, we put in that top, we got all this volume profile. We don't have a TPO for today because of hitting it in the overnight here. And when we tried to break out of yesterday's high, we see a lot of work, and that's where the point of control is this morning. And now that we've put in this range or this zone, GTFO, we got to keep it or break it. And of course, it's a really tight range. We can't keep it. We're not going to stay in that range all day today. Technically, it's possible, but it's very improbable that we're able to hold that range all day. Weekly expected move, 6005. We're not there yet, but we're getting close. That's how far we're expected to move for the entire week. And while we can close outside of the range, we wouldn't expect to, because this range is what we're expected to stay inside of for the week. The yellow candle and the little lines that you see here this morning, although all of this may be a bit noisy, this is the door pattern, day 1 open range, DOOR. And of course, some use a 3-day pattern. So it's not just a 1 day, it's a 3-day. It's very much like an open range, only it uses a new month's candle or a new month's count. Doesn't work very well on the futures either, by the way. It's more effective on equities. Still above the 10-day moving average, holding within this zone. It's a really good spot to be. Got a lot of history of doing just that, just holding out. It's a good, steady, bullish place to be, right? We kind of look at the zones that I was highlighting. It's a nice bullish backdrop, and that's the kind of market that we're in right now that we're highlighting. The problem is we're not going anywhere, right? With all these other areas that I marked, we were getting something done, not really getting much done here. So we don't have a backdrop that says, we're going to crash and burn at this point, but we're not following through with all this bullish push and bullish bias. We've got the fuel and we're just not going anywhere. Of course, that can change at any time. Looking at where we are on the 10-week, more than 3.5%. We're on the climb back up. So far, that hasn't ended. We're still under the 4% level, so we're not in critical territory, but we are a bit extended on the weekly. It's not extreme yet, but we want to keep it under 4. The idea would be that we stall out either at the 4 or before the 4. And what we're talking about is 4% away from the 10-week moving average. From a growth versus value and a capital rotation standpoint, sure, growth is doing better than value, but we got everything moving in the same direction, right? It's not like we left one behind or that one's going in one direction and the other's going in the other direction. It's just that growth is outperforming value, but they're both moving in the same direction. Consumer discretionary over a 5-day period is a bit weak compared to its peers. It's really holding back. So looking at what we've got this morning, Bitcoin is down. China's up. Chips are up with China. And really, I mean, the Mag 7, it's up. It's just not up enough. So all we have at this point is China and the Mag 7 against Bitcoin. And we can see a lot of other things moving in the right direction. They're not enough, right? So the benchmark that I use is 0.5%. So all of these that are below a half, they just don't count. Uranium is leading this morning. So those SMRs, all those nuclear stocks that we've seen moving yesterday with CEG and OKLO, all those guys. And then China, chips, and that's it, really. The rest of these are just not enough. And chips have really been holding this range up here for a while since the second week in May. Hasn't really been able to get through. Big round number 250. If we can get through it, we do have some zones overhead to deal with, like that 260 level. But from 250 to 260, I mean, it does leave some room for us to move. And it kept the breakout of that previous zone, right? That 230. Really, it ran right through it like it wasn't even there. So it needs to keep it. Otherwise, we're likely to retest the bottom of this range again. So SMH may be setting up for an opportunity to play. If it's going to be a short, this is the best place to short it right here. It's an LRE, right? Low risk entry. The perfect short right up against the ceiling. Now, if you want to wait for confirmation, then at the bare minimum, get back inside of the previous day's price action, right? So at least break through the close of the previous day. It's like 248 if you're looking for some sort of confirmation. Otherwise, you have to wait for it to break the low of this range, so 233, and then try to go for the gap, 223. Me, I'd rather just play the short off the high. At least if you're wrong off the high, the loss is really small, right? And to me, it's more important to just deal with a small loss than to try to never lose, which is impossible. You're going to lose anyways, eventually. Losses are inevitable. So after we wrapped everything up yesterday, the base case argument was that we were going to hold the line because there wasn't any expectation that the jobs data yesterday was going to be very impactful. And of course, that changed, right? We ended up getting a positive vibe, and the market took it and ran with it. And we had that breakout that continued all day. We're going to get more jobs data today, and throughout the week, we're going to continue to get more jobs data. At any time, that warm, fuzzy feeling that bolstered the push yesterday can dry up. And that's what you want to keep your eyes on today. Any sort of negative bias starting to push through in the headlines. And there's a couple of things to focus on. There's that bill. There was some comments from Musk, right? And that can sour the Senate on it before they even start making public statements. We still have the bond issues. We had some moves in the dollar in the overnight. So, there's things that can start to come in this morning that can change all of this around. But otherwise, watch the headlines on the job numbers and the sentiment and the takeaway from that. The numbers surprised yesterday, and we could see more of it again today. GTFO, right? We got to get out of the box. And right now, the box is really tight. It's really narrow. Just get out of this, which would give you a VWAP break on the downside or an inside day breakout on the upside. On the upside breakout, you got the call wall. That is the target. It's also last week's high. So pretty simple. Get to the call wall first, then, we'll evaluate it at that point. Otherwise, break this zone's bottom, get through VWAP, aim for the 4, start working our way back down through the previous day's levels. We're not looking for a significant sell-off here, right? All things considered. $59.32 cog line, getting to the lower edge of the ADR would not put us in a, quote, bearish market environment. We would still have a higher low. It's what we've been setting since last week. Higher low, higher low. A pullback here would just be another higher low. It would not be, a bearish maneuver. If we get above the 60.11 cog line that we were just talking about, we got 60.21 overhead. That'd be an inside weak breakout and a reasonable place to pause. That's what I got, guys. Be careful, be safe. I'll see y'all tomorrow.